I am blessed to be able to host this panel with the topic being the opportunity in precious metals and their equities for both generalist and specialist portfolios. And we are going to go around the dais here and have the panelists tell you all about themselves. We have Jeff Clark. He is the gold advisor, gold and silver analyst. Joe Reagor is the senior research analyst with Roth Capital out of Newport Beach, California and Canada. Steve Todoruk is an investment executive with Sprott Global Resource Investments. And Dan Denbow is an independent investor who has joined us today. We're going to talk amongst ourselves and let you folks listen. And hopefully we'll all learn something. And at some point we'll take questions from the audience. As I mentioned in our meeting here with these gentlemen, these questions are questions I've been asking to an audience to a panel for maybe 10 years or more. And they're virtually the same questions, just a different venue and a different time. We're not going to talk about predictions of gold and silver prices. We're not even going to discuss what we think those prices are going to be in a year or next year or 6 months or next week, because most likely all of us will be wrong. But we are going to give our opinions on many of the things that are happening and may happen right now. So let's start with you, Dan. Tell us who you are and why you're here.
I was here because I was invited, which was nice of one-to-one to invite me here, so that was nice. I've been in the investment business for 23 years. I was with USA in San Antonio. I ran the USA Precious Metals Fund, also ran a couple dividend strategies for USA, about $4 billion in assets before they sold the fund complex to somebody else, and I became a synergy. Never knew what that word meant till that happened to me. And I director on a couple of gold companies. One's a private Finnish company. One is a Ontario exploration play that I ended up getting volunteered to be the CEO of a couple of months ago. So I've been enjoying that experience. And as I said in the morning panel, I'm also from Texas, so I do have an oil and gas company as well. So I don't have cows at the moment, and I need to buy a couple of cows so I can fulfill my Texas prophecy. But I do have the oil side at least.
Thank you. Joe?
So I'm Joe Reagor. I am a research analyst for Roth Capital. I've been covering the mining sector since 2007 across a couple different firms. I live here in Nevada, so when I was asked to be on the panel, it was really difficult to say no, and also to attend the event. But thank you to One for hosting this event and for the invite. I'm known for kind of being to the point in my writing and to my views on companies and on the sector. I spend a good deal of time meeting with different mining companies, a few hundred a year. So I have pretty wide-reaching view on the mining sector as a whole. I'd say I spend about 25% of my time on gold and silver, and the rest on other minerals. So it's great to be here and great to be on this panel. Thanks.
Well, thanks for coming, Joe. Jeff?
Yes, I'm Jeff Clark, the gold advisor, I guess, as you put it. So I come from a different perspective. I'm more on the retail side. I have a newsletter writer background. My father was actually a gold prospector for a period of time, and he was relatively successful. So I'm approaching it from the retail side and really like what I do on the website, and mostly focused on gold and silver, mostly early stage opportunities. That's where the food chain I like to eat at. But we'll be adding some copper and lithium and other plays sometime here in the near future. So,
perfect. Thank you very much. And you, Steve?
I'm from Vancouver, Canada. I went to university there to study geology, becoming a gold geologist, and then worked in the field for mining companies for about 15 years, and then progressed to running my own junior mining companies for another 12 or 13 years. And then Rick Rule asked me if I'd consider moving to San Diego to become a stockbroker and pick gold mining stocks for his company. So sort of combine that mixture and have a pretty fixed niche of what I'm looking for in junior mining companies. So I travel around the world to different conferences and looking at mining projects and for my clients to invest in. So
when you introduced me to yourself a while back this morning, Steve, and you told me that your background, you said you're primarily first a geologist and then a stockbroker, and then Rick sort of handpicked you to for the job that you have right now. I was fascinated by that because there's so many brokers in our business that don't have the background that you do, but yet deal in the sector. And I would think it would start with geology first. It should start with geology and then team with regard to investing in any of these stocks. So I think you're probably somebody to follow. And you have 400 clients. I don't know how you keep track of that. So I know we can't get company specific, but let's talk about some of the successes that you've had in the past and now in this troublesome sector with gold looking like it's going to reach 2,000 and stay there. I'm not making a prediction. It's very close to 2,000 right now, so that's fairly safe.
Too late. You already said it.
So, I mean, what's your level of excitement? And I want to get this into a generalist perspective too, because why this sector as opposed to so many other possibilities out there to put your hard-earned money or your easy money, however you want to call it. And put the mic near your mouth, please.
there's probably 1,000 junior mining companies in Canada, another 1,000 juniors in Australia, and the role of the exploration companies to go exploring, looking for new deposits. Major mining companies, very much depend on those exploration companies out there finding, the new deposits of the future. And that's what I try and focus on is the companies that have the next big deposits and get my clients investing in those companies.
So guys, are early stage companies that maybe have never started drilling or have very old data, are they worth even taking a look at right now in this market? Anyone?
Well, there's a lot of alternatives that have already done the work. And what you can buy some of these companies for, it's really incredible value. So it makes it very hard for companies that are just starting to with just field work, which is what you're describing, not that actually has some drilling done and can actually point to where the resource is. To his point about the majors, Goldfields several years ago, Nick Holland came out and said, we're horrible at greenfields exploration. And he just killed the whole greenfield budget because we're just going to use exploration companies to do it. The problem is we don't have proper funding for the exploration side to be able to try to drive a lot of these ideas. And so a lot of these 2,000 companies he talks about, a lot of them are just stranded for the lack of capital and ability to move projects forward. We need a better funding source for the exploration side of things.
Well, that means there's going to ultimately be a crunch for new product, for new inventory as you move on down the line here, as the demand increases. So, and since there's no funding for juniors right now, a lot of these juniors may be disappearing. What's the solution of it, if any?
Higher metal prices.
Can we count on that?
With higher metal prices, we'll be able to mine the old deposits that were found 10, 20, 50 years ago that were uneconomic at the time. That helps solve part of the problem. I've already been talking to a couple of companies here that only maybe have $500,000 of work planned for this year, and that's a drop in the bucket, but at least it's $500,000. And when you combine all the companies, they've got different budgets, and new deposits will be found, but they're getting harder to find for sure.
I think some of these juniors need to go away. So
Definitely.
How do they go away? What's your recommendation
they don't
for that?
get funded.
They don't get funded.
And the better companies that are getting funding right now, that's a good sign that they can get funding, especially if it's not $1 million, but it's $5, $10, $20 million. Those kind of budget, that's a good hint that company may be worth looking at and may be able to stick around obviously depending on the geology. But I think some of them need to go away, and that'll shore up the industry, and it'll make the better ones rise to the top.
Who are these better companies? You had something to say, Joe?
Yeah, so kind of following on some of what Steve said of older mines that were no longer economic, some of the best performing mining stocks of the last few years have been projects that were buried inside of a major in their reclamation department and then was vended out because when it hit the end of the reclamation requirements, the majors don't really want to then start greenfield exploration or brownfield exploration again. They sell it to a exploration company to evaluate, and that is one of the best sources I've seen of great projects. I think we all know a few off the top of our heads, even if they're not the same ones, where that's been the case. And I think that on top of that, this idea of some of them going away, we find one of the easiest things to do for, let's call it, pre-PEA stage companies is to look at the ratio of how much money the company is raising and spending to how much is going in the ground. Mm-hmm. And a lower percentage going in the ground, the more that company needs to go away, one way or another.
When I was running my juniors, you always have to look for new projects. The first place I'd go is try and get inside the major mining companies through whether it's mine shutdown, like Joe referred to, or mergers between the big companies. When there's mergers, there's always smaller projects in there that the majors don't want. They're just too small for them. That's the best place to go looking for good projects.
Are you still aware of these when they happen as a stockbroker now working with Sprott, and are you making phone calls and saying, hey, this is coming up here, you ought to act on it? Are you involved in that arena? No. Why not? Conflict of interest?
No,
you
not
don't
at
care?
all. Too much work.
Too much work.
One guy.
Too much. Do they come to you though? Do they come to you?
No, I have no reason to talk to the majors at all.
And they know that
I've
now.
lost my connections with them. I'm dialed into the junior mining sector, so that's who I want to stay in touch with.
So I'll look at those. Really, I love early stage. I love exploration. It's kind of in the blood with my family. But what it's got to be for me is not just early stage and not just a big land package. It has to be something that shows promise of multiple projects, not just we have all this land to explore. It's got to show promise of multiple projects. Got to have a top geo there. And for me, it's got to be in a pro mining jurisdiction. I'm going to lower the risk because junior mining is already a highly risky, sector. So why add to that risk? It's kind of my perspective. So, I like early stage, and that's where I eat.
I very much disagree with you.
Oh, tell me why.
I don't like companies having multiple projects because just choose through the money. You've got to be focused. Time and time has shown that that's not a good approach. And ideally, you make one. You make a discovery. That's what everybody's trying to do, and then you absolutely just focus on that project. You may as well get rid of everything else, and that's going to be your future.
I disagree with you. No, but seriously, I look at the go big or go home type of thing. So I want something that's big, and if there's multiple projects, hey, if this one that they say is prospective doesn't work out, there's 7 other brownfield projects, the prior mines that have been there that they can still explore. So maybe we don't disagree that much. But I like the go big or go home approach. And if you're going to go early stage, you need to have an edge because anybody can stake ground to be early stage. So,
but if you see that go big or go home, if your eyes are bigger than your stomach and you can't finance these go big or go home projects, you're screwed, right?
Good, then they need to go away.
So go big if you have a budget.
Well, or a
That's
global market, or a global market where everybody's share price goes up and it's a lot easier to raise money.
Yeah, I mean, you do need the focus, especially to be able to attack and go after what you're going. You do see a ton of companies, they'll have 5 or 6, and they think by having a big map and all over the place, it shows that they're worth a whole lot more, that their NPV should be a whole lot more. But if they can't deliver on one of them, how are they going to deliver on 6 of them? But the yin and yang of it, then you get into debate about scale and having the scale to move a company forward. So a small company like the one I'm trying to turn around, being at that size, your corporate overhead just to survive as a company chews into the amount of money you got to put into the ground. And so there needs to be consolidation of all these so that you can have a better geology staff, a better finance staff, that you can have some synergies among those and move that forward. But then you have to figure out who's going to get the capital, and allocating the capital becomes the real battle inside the company of which project deserves more money. And that comes to which meter gets me the most ounces to grow the resource, and where can I prove that out? So there doesn't be consolidation for sure. And a lot in the junior space, they're lifestyle companies. Their CEOs making $200,000-300,000. They're flying around to Vegas to, no offense to the conference. They're going to go get drinks and have a big dinner on shareholders' budgets. And that did not deliver an ounce in the ground. And so it's hard, but you have to do it to get the next dollar. So that's why you need some consolidation of companies that can move projects forward, not just some of these lifestyle that their buddies are funding. And then they just sit out there. Probably of the 1,000 he mentioned, maybe 900 probably just should go away, and 100 can advance things.
So can I ask Joe a question? What do you look for in terms of how much, what percentage going in the ground? Where's that break where, okay, that's too low?
Well, I guess that the first starting point there is how much money are we talking? Because the more money the company has, the higher that percentage should be. Just because my view is that if you work for a company that's pre-revenue, you should make enough money to pay your bills, even as a CEO. And anything above that, you're taking from the shareholder. Now, most CEOs would not agree with that, especially of junior companies. But I've seen instances where a company raises $2 million. And if you look at their next year's annual filing, maybe 400,000 of that went into the ground. And to me, that ratio is not okay. It has to be over 50%. Even for the juniors, it has to be over 50. If you can't raise enough to put 50 in the ground, that's the market telling you it's time to close up shop, sell your assets to some other company. Doesn't matter if you get 10 cents on the dollar, because all you're going to do is dilute your shareholders to zero.
Being public's expensive, unfortunately. And so you have a starting hurdle of 400,000 to 500,000, even if your CEO is not making anything, to stay public. So if you raise $2 million, a quarter of it's going to go to staying alive or staying public, and then you can get $1.5 million into the ground maybe. So, running a company is expensive, and being public, and that's what's hard about it.
Maybe to your point of where do they need to go? Private. There's not a lot of benefits to being a sub $10 million market cap company with $2 million in the bank. There's just not that much upside to it for public shareholders. Maybe wait until you're a little bigger and you can get institutional involvement right from day one.
Where are you going to get the money?
It's harder to raise money when you're private. I mean, it can be done. I've certainly done it with the private mining companies that I have. We were intending to go public 2 years ago, but I slow rolled that, sensing the market, and everybody seems to be okay right now, but it's still hard to raise money as a private company because you feel like you have zero equity as an investor.
It depends on the story, the project, and the people involved. I'm being a licensed stockbroker. I'm not allowed to mention any companies that are trading that I'm involved in for various reasons, but I can mention one that's hot off the press called Paycore Minerals. They're in Nevada, and i-80 Gold, who's a fairly well-known company, just took them over because they got projects right next door to each other. And I helped fund Paycore twice while they were private. And I only did that because I knew they had a really good deposit sitting in the ground. It was 1.5 million ounces, a very good grade. So my gut just told me that one day things are going to work out nice here. And it was obvious that i-80 would take them over. There's a case, but it's pretty rare because, again, you don't just walk out on the street and find a good project. These guys went to, I think it was Waterton, and Waterton along the way. And there's always inheriting projects, and a lot of times they just sit on the shelf.
Well, what do you think about a great project that's greenfield more or less, but it's next to a killer story that's gone all the way? Wouldn't that be something you'd be interested to, especially if the geology is identical?
No, there's no great early stage stories. They got to produce something, come up with the good results.
I don't know about
You can
that.
have really good addresses. You can have good addresses.
Yeah, I mean, what's the old adage in mining? The best place to find a mine is next to a mine.
He says no. Steve just said bullshit on that.
I mean, it's all at the end of the day, it is all relative. But you're to the point you're trying to make about how you gonna raise money if you're private. Like, why even go that route? Well, the people who are providing capital, the retail investor who is not an accredited investor, not an institutional investor, they're mom and pop and investing their hard-earned money, as you put it, in these junior mining companies. Very few of them have the financial and mining experience to be providing capital to those companies. And hence, if they were private and that person couldn't, I actually think it'd be better for the investor. That's kind of my thesis. I'm not so much worried about the success of the mining company as I am protecting the public investor. Because, I mean, that's my client, is the public investor.
Just to clarify something, that to fund these small companies, you need to be an accredited investor with a net worth over $1 million. So theoretically, that tells you they're somewhat sophisticated.
Directly.
They got some business savvy, or they got somebody giving them advice.
To directly invest, but you can buy in the open market.
Or you can buy shares, but you
Yeah.
can't fund them.
You're right.
Yeah, just to clarify.
Yeah, but if there wasn't people buying in the open market, that a lot of these deals end up getting done by banks that'll do these $2-3 million private placements with a warrant, and then the second that stock becomes free trading, it goes into the hands of retail investors who aren't accredited, and the warrant stays in the hand of the accredited investor, and that's a big problem. I feel like at that stage, that doesn't mean that a $5 million company can't one day be a $500 million company or a $1 billion company. There's many cases of that. It's just the risk profile and the way the money gets invested. I remember, though, of course, I am coming from the institutional crowd, right? That's who my client is. I'm not dealing with the retail, but it's a little worrisome sometimes for me.
I would argue, though, that what was the market cap of Rubicon before it went away? I mean,
but that was a geology failure. That's what that was.
Right, but that didn't have anything to do with protecting the little guy. All the retail. I mean, market cap doesn't do anything to protect the little guy. That's a big failure.
Where was all the due diligence in a case like Rubicon by all the experts, the big funds and banks that gave Rubicon that money? It's like
Little guys don't know how to do the due diligence half the time.
I can tell you a lot of people look the other way about the numbers. I'm not a geologist or an engineer. I'm a finance and mathematics guy. And sometimes I look through the numbers, in a financial study, and there's a number that's just wrong. Like, it's wrong. An operating cost is going to be higher than the number that's in their study by an order of magnitude. You change it, you rerun the math, and it's not a project anymore. It's a zero. And, from the way my company does things, we just don't cover that company because it's too small to tell anybody to short it. And so, we're not going to tell anybody to buy it either.
Just touching on one of your previous comments there, there's a very good saying in this business, in a lot of investing, is that most investors don't deserve the right to invest. They don't have a clue what.
Agreed.
So if you're a generalist broker or a portfolio manager or a fund manager, how willing are you to expose your clients to gold and silver right now?
I have no problem with it.
Gold and silver, you mean miners, right?
Yeah.
The equities we're talking about.
The equities.
Well, I'm not a broker, but we have clients and they make their own decisions of how much exposure they want. A lot of the people who are generalists who want gold and silver exposure, they are smart enough to keep it to a certain percentage of the overall portfolio. They're educated. On the retail side, I can't speak to that maybe as much as some of the other guys up here could.
I'm a retail stockbroker.
Do you see it growing?
I can't comment.
Do you see that growing, that percentage of people are getting involved in gold and silver now in the equities?
No.
Decreasing?
Also no at the institutional level. No.
Yeah, no.
There's only less every year.
Then where are we? Why are we here? Look, how many people do we have in this room?
we're waiting for 2011 to happen again. And I remember having conversations with investors in the fund, and they were at 20% 20 to 30% because they couldn't lose, and it kept of their portfolio, and kept telling me, you got to get this down, because this dog, when it wags its tail, is going to wag hard, and you need to downsize it because it is a risky area, and you don't need 30% of your portfolio exposed to gold mining companies. No, that's not a diversified portfolio, especially in a portfolio of stocks that have standard deviations like gold mining stocks do. But when it comes around, as I said this morning, for the decade, we talk about a super cycle. For the decade ending, I can't remember if it was 2008 or 2009, fund return 28% a year, because that we were in a good gold super cycle. That it can come around quickly when the hot money comes, just like it comes for everything else. You couldn't, lithium today, rare earths several years ago, silver in early 2011. You couldn't beat anybody off a silver stock when silver is trying to run to 50. It comes back to it. Money goes to where returns are, chases it, and then chases it past expectations and past what returns should be for that. Today, gold stocks are dead. Even though gold's at 2,000, gold stocks are down from where they were when gold was 1,800. But that'll come back around because interest will come back around. We were fighting Bitcoin 2 years ago. Today, we're fighting, banks and everything else. But as soon as the Fed backs off, gold's going to be a bit stronger. And then I think people will start getting interested in the gold stocks. And then the people who are going to feed the gold stocks, the new discoveries, the juniors will follow that when it happens. It's a slow, painful process, but it will come about.
So where are we now? Are we at 2009, 2010, 2008? Where are we at in a comparative cycle? I'm curious.
I think we're in a whole other cycle. And we're not in a financial crisis. The Fed's really caught in between. We talked about it this morning in the panel. Inflation's not going away because as we onshore everything, labor's going to stay higher. Costs are going to stay higher. Inflation's not going to go back down to 2% or 0. So the Fed's going to have a real battle here in the U.S. And then everybody's going to be following that. So I think that this makes every cycle is the same. Every cycle is different. And so we're kind of caught in between. But as soon as the Fed shows a blink, gold's going to rally a bit more, I would think, and that should bring interest back to the space. The problem is the specialist investor is out chasing AI, ChatGPT, whatever else is out there. When they start seeing the returns in the space, and you look at the bigger guys making buku's money, and they can start distributing it, just like happened to oil stocks 2 years ago. It was uninvestable by most people. When you watch CNBC, you cannot invest in oil companies. It's uninvestable. They've been the best things going for the last 2 years. So eventually gold will also become uninvestable. I believe, I hate this being taped, I believe ESG is peaked and people are going to realize that what they're asking for, what they're claiming, there has to be some reasonable balance between. You are going to have copper mines. You are going to have silver mines, gold mines to make it work. Gold's a different animal, and that makes it a little bit difficult. But you need silver to make solar panels. It goes into other things. Silver is not a currency anymore. I know that'll probably raise some arguments, and somebody will throw a drink at me later, probably.
We don't have a lot of silver miners right now, and there's very few pickings from the standpoint of being an investor to take a look at. And you want something with high grade, a reasonable share structure, and great jurisdiction and a team. Do you think the appetite is now expanding for silver?
The problem why there's so few silver miners is there's so few good quality silver deposits to mine. And we're seeing that reflected in the actions of the silver miners, last number of years. They're going out acquiring gold deposits or gold mines. That's not going to change.
So you think the Sonora State is done?
Well, it's like from a geologist perspective, all deposits are getting harder to find. There's still lots to find, but they're deeper and deeper. They're harder to find. They're going to be more expensive to dig out of the ground. The only thing that can, sort that out or solve it is higher metal prices and reasonable cost to mine.
And most silver doesn't come from silver mines. And that's what people forget about the supply of silver is one of the challenges in the whole supply-demand economic equation for silver is Silver is a byproduct and is a efficiency in a lot of polymetallic mines. They use the silver to offset costs, so they don't care what price silver is. They'll produce it whatever because it's covering G&A and other costs of the mine. So it's not mined with the same rationale that you would if you're a gold producer or a copper producer, if it's your primary. The primary guys have trouble with that. You know, you think like Hecla up at the Lucky Friday, that mine used to be, the profit of that mine was driven more by what are the zinc and lead prices, not the silver prices.
I was just thinking.
You could go to those products, you could go parts in the mine that have heavier than those, and that mine cash flow would be incredible, but he's being driven by zinc and lead prices, not silver.
I was just thinking about Hecla and their acquisition of Alexco at a loss to shareholders basically recently, and it falls into this question of which the one-to-one people have given me here about, and I'm sometimes referring to these questions. They're good. Is organic growth coming back to the table versus M&A? Are we seeing these positive M&As happening now, or are there some negative ones too that are hurting shareholders, but ultimately will be good for new shareholders coming into these companies? But then you're again looking at the majors for safety.
I think you're going to always see, a good portion of both. You need the organic exploration like a lot of companies here are trying to provide and do. And, the majors always are cyclical to, are they going to have a big exploration budget for the year, or are they cutting back type of thing? And, we've always gone through that, and I think that'll always be, the scenario.
Exploration companies can be your organic growth. Even though it's deemed M&A, it's exploration dollars being spent by smaller companies. And so your organic strategy really is to use those as your exploration companies and build them in. That's the other thing I was going to say about your portfolio. You need a portfolio of these companies. You don't just pick one horse to ride, because geology happens, Mother Nature happens, and geopolitics happens. So the same way that you would invest in biotech companies and you'd own a portfolio of 10 of them, 2 of them are going to be 10 baggers. 5 are going to be mediocre and 2 are going to go bust or something like that. Same thing you do with the gold companies. M&A at the big guy has been value destructive until you see things like the Nevada complex put together by Barrick and Newmont. That makes a lot of sense. The Anglo Goldfields deal in Ghana makes a lot of sense. That type of where you can get synergies. But for the most part, you put these companies together, there's no synergies. It still costs you the same amount to move a ton of rock on any given day in any country. And so you can't save costs there. Maybe a little bit of buying. So all you're really doing is cutting CEO salaries when you're doing the merger. And then you're basically overpaying for that benefit to it. And then you also lose focus. A lot of guys would tell you, they can run 5-6 mines maybe. That's what Bristow used to say at Randgold. He doesn't say anymore because now he's running a bigger company, but he would always tell you, I can't run more than 5 mines, because he's a micromanager and that's what he sits on top of. And it's hard to stay focused past that. He's got a bigger horse now, so it's a little bit different story.
I do think we're on and I'd be interested in what the panel thinks, but I do think we're on the cusp of more M&A, that M&A is going to increase, because I think it probably has to increase. The mid-tiers and the majors need ounces. We're not finding ounces. The deposits are smaller. The grades are lower. At $2,000, they're not. The revenue is lower even at $2,000. So I do think we're probably on the cusp of more M&A, for better or worse, right? But I'm curious what everybody thinks, because I see that coming over the next few years in this next cycle, let's say.
I mean, what I would comment on that is I don't know necessarily that replacement of reserves or replacement of ounces of production is really the right thing to look at. I think the days of CEOs worrying about growth, and this is for the most part, there's a few of the old guard left that care about growth for the sake of growth. But it's more about ROI and about dividends to shareholders, and it's become a more financially driven sector than it ever was, before. I think that changes the M&A outlook, but the companies, the majors, when they're looking to buy now, I think what they're saying is there something there where I think I can get an ROI that's positive on what I can see today. And then, in that current gold or silver or whatever price we're talking about. And then is there upside beyond that that's untested yet that will be brownfields exploration for us that could keep our company in business and generate a higher ROI over time? And that's kind of where they're setting their barometers, a minimum ROI, long-term upside. But at the end of the day, when you're trying to find these companies, the M&As the companies are going to be taken out via M&A, it's about companies. It's, we've talked a little bit about what's going to bring the sector back. I think the thing that would change this sector is if we could convince generalists and specialists to think, like Steve was saying, about is this a good company? Is this a good asset? Do I want to invest in them? And not so much on, the next time that gold price spikes, then I'm going to make money on all of these. Like, that way of thinking is how you get burned, because Dan said it, the generalists were showing up when silver was almost 50, buying everything.
But don't you think they'll do that again?
You can only burn somebody so many times.
But there's so many
was a
different
decade
people out there left to be burned.
They're all greedy and they all chase returns no matter what it is. I mean, they came back to the tech stocks. They got destroyed on pets.com or whatever it was in 99, and they came back again to the internet stocks. They made the same mistakes again, chasing non-revenue companies, and it's going to change the world, whatever it is, and they're going to do the same thing with AI. So I think it's going to happen. I think the one way to get Generalist is to actually produce financial returns that they can understand and they can compare to JP Morgan and Honeywell or any other company. And a generalist can look down my portfolio and say, look at this cash flow return or cash flow yield of Newmont, Barrick, or B2 Gold, or whoever it is, and actually be able to compare it. We get caught in this trap of NPVs and NAVs. They're all made up with fake numbers and discount rates. Nobody can understand why a 5% discount rate on something that has incredible risk just makes no sense to people. So if you could show them how it's going to, in 10 years, it's going to generate a cash flow yield of X, they'll buy it and they'll be happy with that. We can't do that. And exploration companies have a harder time. And that's why you compare them to biotech or something else that is exploration-like.
I'd like to think that the last down cycle around 2015 that was brutally harsh for everybody in the mining industry, that forced all the majors to start cleaning up their house. And they've done a commendable job along what you're saying. And it's in an attempt to try and win over the generalists. And I really hope we don't see that again, even if gold goes to $2,500 or copper's $5 or $6 a pound. I hope they remember the lessons because they were brutal. It was healthy for the whole sector.
There was a lot of write-offs.
Yep.
And that's what keeps the generalists away is they get in, they chase the returns. Mm-hmm. The top happens because inevitably, the last guy in the door usually gets burned. And then when they're writing off all these assets, we're all still around and we have to watch it. And the generalists have all fled back out those same doors. And then they complain about how we're capital destroyers. And it's like, well, you did your investing at the top. That's capital destruction.
Kind of touching on that and backing up a bit, when I said most investors don't deserve the right to invest, especially in a sector, whether it's early stage biotech or something. If you're going to invest in these stocks, look for the juniors that major mining companies have done private placements in. They own 9% or 17% of a junior. At least that's some of an endorsement. Doesn't mean it's going to work out. There's lots of examples where majors make stupid moves like that, but at least there's some due diligence been done by the big company, and hopefully Big Brother's looking over the shoulders, making sure that a good portion of the money's going in the ground. So that would be a tip for most people.
And they can provide good technical expertise and help to look over the shoulder and say, have you considered this? And maybe turn the drills around 90 degrees.
Totally.
No telling what you might find.
This has all been fun, but gold and silver are going to go into another bubble. That's going to happen. The generalists are going to chase it. Stocks are going to go to the moon, and then it's all going to crash again.
Well, I'm going to finish on this note. I was doing business with a banker this morning, closing on a piece of real estate. The banker was probably in her late 20s. And She asked me what I did, what my job was, and I told her, and she knew all about gold. How? TikTok. And I had another friend, conversely, ask me for some recommendations on the lithium company, and she's never asked me about recommendations for anything. On 5 years, she's ignored my job more or less. So, at some point, we're losing sophisticated investors from gold, and they're traversing into the battery metal space. At the same time, we're getting more interest in precious metals, perhaps from a younger crowd, and that's really good. I want to thank you, gentlemen, for joining me on the panel today. This has been a fantastic discussion. Jeff Clark, Joe Reagor, Steve Todoruk, and Dan Denbow. It's been a real pleasure. Thank you.
Thank you.